Welcome to F.A.C.E, Bruce Fraser. How are you, buddy?
Hey, great to be here.
Really pleasure to meet you, Bruce.
Thank you, Dale. Well, I'm excited to be here. I'm thrilled that we have a chance to talk about Wyckoff.
Okay, and
or anything else you want to talk about.
You know what? Do you know how to share a screen on Zoom? It's the green screen share button. And you already answered a question for me because, you know, I called it Wyckoff and Blake called it Wyckoff. So now I know the correct pronunciation of it. So, yeah, if you could share your screen, you see the drop-down menu on share screen.
Share screen.
So you and I have been around for a while, haven't we, buddy?
We have. Can you see my screen there?
Yeah, I got the weekly Wyckoff market discussion application. Beautiful. So before we get going on content and your cartoons, nice, creative guy. So, you know, I found a lot of creative people that came in to be traders. They find ways to express themselves in this business, the creative side, instead of, you know, just being number crunchers. And sometimes that comes from where they started and how they got into the business. So I'm going to test your memory here today, Bruce.
Oh, gosh.
Yeah, tell us what you were doing before your first entree into the trading investment arena. Was it something that you knew early on you wanted to do? I know a lot of people, their fathers were traders. You know, I knew a lot of my friends, their fathers were at the CME, so they ended up in the business. How did it happen for you?
Well, it's my family my family business was horse racing.
Oh,
and
wow.
So I started at a very early age, absolutely fell in love with the tracks and horse racing and all of the interesting people. And that was my dad's business. And so, I don't know, I was like 7 or 8 years old and I'm like, Dad, you got to put me to work. And so I spent the next 20 years working in and around racetracks up and down, really around Central and Northern California.
Oh, okay.
And so it was just as I look back on it, it was a great experience for me relative to the financial markets. And it was, I got to know a lot of really interesting people. I had the great fortune of working at Bay Meadows Racetrack. And eventually I had been working as a young man there so long, I had seniority. So I was able to get a really good job working in the Turf Valet parking lot. And so I was right in front of the Turf Club and I met all the really interesting people that came in through the Turf Club, which was pretty amazing.
Did you bet?
Oh, for sure. Yeah, you can't be around the racetrack and not. But I learned a lot. And one of the things that I learned early on was I started doing the math on probabilities. And I picked up a book as a kid, early teens. I started looking at probabilities and I realized what how low the probabilities were of success in horse racing. And I felt that I was very fortunate that I was able to take home a paycheck every day from the racetrack. And so I stopped gambling. But the other thing that happened was that I got to know some of the really best handicappers in the business. And these people, men and women, showed me what they did and how they did it. And it's amazing the parallels to trading. Financial markets.
Yeah.
And so, for instance, just as a simple example is one of the things about great handicappers is they handicap all the races and they actually participate, bet, gamble in very few of them. And these are only the ones where they feel like they have improved the odds in their favor. And one of the ways that they've improved the odds is that they see horses that are very good horses that are mispriced. And so that means that their odds are higher than they think that they deserve in the race, meaning that they have a good chance of winning. And the marketplace, this is pari-mutuel wagering, so all the other gamblers have underestimated the value of the horse in the race. And so tell me that doesn't sound like financial.
Yeah, like kind of a contrarian value that no one sees except the experts.
Exactly.
Value investors and so
Yes.
forth. Okay.
So anyway, so what happened to me was that I had worked my way after graduating from college. I worked my way into a management job at the track, which was a lot of fun. And I really felt that I was just going to spend my whole career in horse racing. And then this was in the early 80s, 1981. I was working towards my finance degree, graduate degree, and in San Francisco at Golden Gate University. And my professor said to me, he says, this is a course that you absolutely have to take. And this course was technical analysis, graduate course, technical analysis taught by Dr. Henry Pruden. And Hank Pruden was teaching the only graduate course in technical analysis at an accredited university in probably the known universe. And so here
what
was
the
right
textbook, Bruce? What was the textbook?
It was Martin Pring, Technical Analysis Explained. And in later on, Martin Pring became my business partner. And I just thought he was a god, and I still do. I just absolutely adore him. He's just a great person in my life, and we collaborate a lot, and we're good friends. But at that time, I just had his book, and so anyway, with Hank, I was taking his class, and like 2 or 3 classes, sessions into the semester, I had made up my mind that this is what I was going to do the rest of my life. I absolutely loved it. And the thing that I loved about technical analysis and charting, chart reading, the whole thing, was that there was a probability bias in technical analysis that didn't exist in horse racing. You could never really improve appreciably the odds in horse racing, but you can through a great methodology and approach and good risk management, you can actually create a positive probability bias in the financial markets. And the bet sizes are just significantly larger. So in every way, I saw this as being the better path than the career I was in. And so I'd made up my mind that when I finished graduate school and got my finance degree, that I was going to go into the financial industry. And that's exactly what I did. So I've been doing it. Did you
start off as a broker somewhere?
I did. I was at Dean Witter, retail broker, just on the northern edge of Silicon Valley, which was very, very interesting because I was there for some very interesting times, and also had a number of people out of the valley that had very successful careers and had been in critical startups and so on. So I learned a lot about the way Silicon Valley worked in my career there. And then the other thing was I had Hank and my other business partner, Joe Turner, as great mentors to me. And they really taught me how to be a really good broker for my clients. And so they helped me develop a business plan that really worked for me. And what happened was, and my goal was eventually to get sort of across the street, to go from being a retail broker to being a portfolio manager. And as a consequence of that, I was literally, as an entrepreneur, started 2 very successful investment advisory firms that I worked in for many, many years. And my partner in one of those firms was Martin Pring and Joe Turner. And so that was what put me on the other side of the street and had me becoming a portfolio manager.
You really were fortunate, Bruce, the journey you had and the connections that you made. I mean, having a guy like Martin Pring, I really have respected his work, the progression of the economy and how certain sectors at certain times outperform or underperform. And, you know, you really, I mean, compared to now, to what people have to search through and discern and due diligence to find true mentors, and you know, not just someone trying to get into their pockets. So yeah, we were lucky in those days. I know I had the exchange floor of people on the floor whose brains I could pick for quite a few years. So great story, Bruce. You really
and one other thing that happened for me, just to put a bow on it, was that Dr. Pruden had developed this great class at Golden Gate University. And in 1987, he decided he was going to go on sabbatical. And so he asked me to take over this class. So I was teaching this graduate course in technical analysis, which was a survey course of a number of different methods and techniques.
Did you use Edwards and McGee?
Absolutely. That was
my Bible.
That was the first book I had, and I took it with me wherever I went. And Charles Bassetti, who now edits the Edwards and McGee series, is a dear old friend of mine, and he is a teacher, adjunct faculty at Golden Gate University, or he was. And so I've had the great fortune of being able to spend time with him. He worked with them, and I was able to pick his brain a lot. So that was very fortunate also. But I spent 30 years teaching graduate school at Golden Gate University in technical analysis, and we taught courses in many different subjects. And the other thing that we had is we were kind of the hotbed of technical analysis really anywhere. And so we were the epicenter at Golden Gate, and all these amazing people would come to San Francisco and come through the university and teach and give lectures. And I just wrote down a few of the names of people. Dick Arms, who was a dear, dear friend, Bob Prechter, Justin Mamus, Joe Granville. Joe Granville's somebody I was able to spend a lot of time with, and I think he's one of the geniuses of technical market analysis.
I remember one of his famous statements was, "What is most obvious is obviously wrong."
Yes, and he had created incredible indicators that many of us, we use
still
these indicators, and we don't know the origin of them. Well, a number of them come from Joe, and Joe was very kind, spent a lot of time with me, and so the community is just incredible. I mean, they just love to give back, and
it's still that way.
It's still that way. Yes,
we're an example of it right now.
Absolutely. And so anyway, I don't want to go on and on about this, but
it's a great. Have you written a book yet? My journey in the business. You have a book, and I'll put you together with Schwager, and maybe he could help you out.
Jack came to as soon as he wrote The Market Wizards, he came to San Francisco and spoke at Golden Gate University, and he's been a very generous person with us in terms of sharing his time and experience with the Market Wizards.
So how did you gravitate towards the work of Wyckoff?
Well, probably the best known Wyckofian was Hank Pruden. And Hank was teaching all of these different methodologies, but he really, in his heart and soul, he was a Wyckoffean. And he would teach a lot about Wyckoff in his courses. And so I just immediately gravitated to that. And then I did my graduate thesis for him, and we did it on an attribute of volume using the Wyckoff method. And we were able to get that published in the MTA Journal. So that was like one of my early experiences, and I've just been a Wyckoffean ever since. And then in '88, in '90, Hank and I started teaching a graduate course in Wyckoff analysis, and we taught that for 27 years.
So you
Together,
probably
team taught it
spawned,
mostly.
you probably spawned many traders over the years.
There's no question. We've taught probably in the thousands,
Yeah.
Wyckoff method, and they're out. And even now, we can even reach more people through this incredible technology today.
Any of them end up, I have a belief that, and Jack's last book proves it, that the most famous aren't always the best. They may be the greatest marketers, but it doesn't mean they're the greatest in the market. And,
Well,
Jack's recent book of unknown market wizards.
yes.
Did you spawn any that reached any kind of notoriety like Richard Dennis's Turtles?
A number of them have achieved very high levels of market performance. And, I'm not going to reveal any names,
Okay.
but in many, many cases, they don't really want the notoriety. And the thing is about the Wyckoff method is that it's a whole philosophy that's built around really sort of obscurity, because the actions and the activities of what we call the composite operator is to make their trading and investment decisions in the markets and not bring attention to themselves. And so I think that they take that to heart. Now, one of the best Wyckoffeans that I know was actually a student of ours in the '90s, and this is Roman Bogomazov, and he's an incredible trader, but he's also a teacher. And so this is his website, wyckoffanalytix.com. There's a lot of good content here. He publishes my blogs and my video blogs, which really I do those at stockcharts.com, but there's also a lot of other great content.
I noticed that you're on there, and David Keller and Grayson Rose, and
yes,
I was curious if we could, before we get to this framework of
sure,
Wyckoff, your cartoons that you had up there with 2021 big investment themes for 2021. What are you trying to say there on the left and on the right?
Well, so here is I think a condition that exists in the markets now is that you can see up here this wagon with everybody on it, which is national prosperity. And the national prosperity, which is really the economy and so on, is lagging way behind the stock market boom. And this is typically how it happens, is that the stock market goes first, has a big run, and the economy is weak and listless, and it just sort of tries to find a way to get in gear and go. And so this is just representing the fact that the stock market is often out of phase or out of gear with the economy. And as a matter of fact, it's typically the case.
Yeah, it's a question that, since the COVID crash in March, that I've gotten from so many people. Dale, why is the market doing so well when, we're on life support and the federal government is sending out checks just so people could stay indoors? And, you know, it's not easy to explain to people that it could be a monetary phenomena that may not translate to the real economy.
Well,
How do you answer that question when I'm sure you've been asked, Bruce, why is the market exploding to the upside with, you know, millions of people filing for first time unemployment claims? What do you
sure.
tell them?
So this would be my this is my roots working all those years with Martin, and the how the economy actually works is that the economy and the financial markets are actually in competition for capital, and so the
Interesting.
economy actually, if it's somewhat listless and doesn't need a lot of capital infusion, then as you have a profligate Fed that's printing money and pumping liquidity into the system, that liquidity isn't needed in the real economy, and that's how economic expansions begin. And so that money migrates its way over into financial markets and speculates.
Okay.
And so then what happens, and we're starting to see that now, and if we have a chance, I'll show you some charts, is that we're
Sure.
seeing the increase not only in the economy in 2021. So there's a great potential for the economy to get better simply because of the liquidity, which is what the Fed wants. But the other thing that creates competition for capital is inflation. And so as inflation heats up, the cost of goods and then speculation in goods and materials, that also can rob the traditional stores of value, which is the bond market and the stock market. It can rob those markets of liquidity, meaning that money migrates away. Money's fungible. It goes where it works the hardest. It goes from the stock market and works its way over into
Commodities.
other asset classes.
Yeah. Yeah. The grains have been on
Well,
fire. Hard to find a chart that isn't in a bull trend, except
exactly.
maybe the bonds, right?
Except for the bonds. And of course, the bonds are now reflecting the fact that interest rates are going up, which tells us that there's demand for money. And this demand for money is coming somewhat from the real economy. So we're starting to see the evidence of the real economy starting to compete with the bond market. Stock market and the economy can go up together and typically do for a period of time. And so we would expect that that would be the case going forward, is that we're going to start to see better economic numbers, and the stock market will like it. May not be
Okay.
so good for the bond market.
Okay. Is there also a chance that the real economy could start to do better next year and that the stock market doesn't give us the same performance it gave us when the economy was still struggling?
Typically, yes. Typically, what happens is that you start to see rotation. You start to see it becomes a more selective market. Oftentimes, the stock market will sort of lose its trajectory, meaning the advance will slow down somewhat on the way up. And so you'll still have positive returns from the stock market, but they may be, sort of the easy low
Compressed?
hanging fruit
Yeah.
is early in the uptrend, which is what we saw here in 2020.
Okay, well, to let's get to the charts that you wanted to show today, Bruce, and tell us what you're seeing.
Well, this chart, just to set up sort of the condition for Wyckoff, is that this is just the classic life cycle model of the
Print.
stock market. It could be any asset class really, and it can be any time frame, because the markets are fractal, as we all know. And I saw some great examples in some of the charts that were being put up before I came on. But there are these phases, and one is, and this is the really important art of Wyckoff, is that you have the accumulation phase that comes at a cyclic bottom, and in the process of building or accumulating shares for a markup. And so who's accumulating shares? Well, it's the composite operator. These are the super shrewd, smart, value oriented. These are like the handicappers we talked about. They're buying good assets at bargain basement prices, and they know exactly what they're doing. And so we see here, and this is sort of the Wyckoff labeling of an accumulation. The other part and is these pauses in the uptrends along the way, which we call reaccumulations. And so this is the process. Bases don't happen willy-nilly. They happen for a reason. And the reason is that you have large informed interests that are basically absorbing all the stock that's available. And when they absorb that stock that's available, eventually it becomes very difficult to buy. And so the early adopters of this theme will lock up the shares. And the only way that a large institution who's not an early adopter can own these stocks is that they have to be willing to buy on a scale up, because they're so
where do you
difficult.
think we are in 2021 on this graphic that you have?
Well, I'll actually show you a chart here, but I believe that we created a big accumulation back in March,
right,
and that we're in the markup phase. And I would say that we're like somewhere maybe right in here, and that there's still more upside. Now, this is a truncated view, so you could have a series of these reaccumulations on the way up.
okay.
And then eventually you get what is distribution. These are the large interests that bought at good prices, held them for a very long period of time, and now are disgorging their shares very deftly, carefully. They're selling their shares at an average price up here because they feel that all the value has been revealed in that position. And then the stock is typically considered to be in weak hands after that. And that creates downtrends. So let me give you an example of this. So this is just this is Shake Shack 2018. And so you can see here that we identify these different phases of accumulation. This is one of the genius aspects of Wyckoff, is that every one of these phases has a different price volume characteristic to it from the prior one. And these steps along the way tell you that absorption has taken place, it's nearly complete, and that once the absorption has occurred, you can see that there's a total change of character here in the way that the stock trades. And it just goes into this vertical climb and then has a pause or a backup, often called the last point of support, and then another vertical climb. The only thing that can cause that is the fact that the stock is very difficult to buy and institutions want to own it. Now, what happens is in a downtrend, the stocks in a downtrend, the stock is in weak hands by definition. And eventually there comes a value point or a price point where the large interest, the composite operator types, will start to accumulate these shares, and the stock is systematically taken out of weak hands and put into strong hands. And so once you've done that, absorption has occurred. The stock, even though you can't see it in the chart, and this is the trick of it, is that you're looking at it anecdotally in the way the chart's trading. But this stock has a different composition of ownership over here than it does over here. And this is what allows it to propel itself upward at a very high rate, fast rate. And then here, the other thing that we do in Wyckoff is we do horizontal point and figure counting. And this is an age-old technique. Point and figure charting is maybe the oldest charting technique.
Yeah,
and
all the floor guys used to do this, have clerks doing their X and O's for them, right?
I had many floor traders that were dear friends. I would go down there. They had these little like cards that they would hold, big stack of them, and they were just for doing point figure charts. because it's just easier to do point figure charting on the fly than it is to do vertical charting. The other thing you can do is that you estimate the potential of the upward move of an instrument, stock, index, etc., by counting the horizontal count area, this is the accumulation we just evaluated. So we know stock is in strong hands throughout this. So we count back, and this gives us a count 70 to 76. This larger count goes 123 to 130. And in fact, it went right to, if I remember correctly, $70 and touched that. And that was the high point. Now, here's a current example, Molson Coors. And this is a stock. We do a little stock selection newsletter. You can read about it at the website. But here, just right before the test, there was a spring, and we profiled the stock in our letter. And then it came down for a test of the spring, which is typical and expected, and look at the vertical launch that's occurred since then. And so this really shows that everything that occurred over here from the climax onward was accumulation of shares. And so now Molson is just up and out of this accumulation area, which means that there should be the initiation of an important uptrend.
Okay, beautiful.
Yeah, so here, this is just a distribution schematic. We have a number of them, but also importantly, by the way, I did a video that's going to air today on stockcharts.com, and it's your daily 5, and they have a different person every day. But I do a little mini 14-minute workshop on reaccumulation. And so it's free, no charge. And it's after the initial airing, they put it on YouTube. So
yeah, so what you label reaccumulation, Edwards and McGee would say that you would be looking for continuation formations like bull flags and triangles, and
yes,
against, not reversal formations like descending or ascending triangles. So yeah, so
and it's all the same principles. I would say
right.
the one thing that maybe Wyckoff does differently is the way that he broke up the consolidation areas into different behavioral concepts. Very ingenious is the way that phase A trades versus phase B versus C, and so on. And so we spend a lot of time when we educate on Wyckoff teaching the student how to differentiate between the different phases and how to see them in real time. And so we do a lot of work on that.
Bruce, I bet that you and I could talk for hours about this, and I'd love to have you come back, but what would you wrap it with, and what would be the most important advice you could give to anyone in the markets?
Well, just to show this is a chart of the S&P 500. This is the cyclic accumulation that occurred. We can see it on a point figure chart.
Yeah.
And this is the count objective that we get. So I just show this to show that there is the potential here. And in the reaccumulation, this is an example of counting reaccumulation. And this count more or less confirms this count, that in the very nature of the base itself was the indications of how far up the market could go. Now, that doesn't mean it can't. Yes, and that doesn't mean it can't get up here and spend time and then go again. And so my only point is that there's some great techniques out there that are very helpful. I'm going to show this one. This is the Nasdaq 100. This is a chart that Roman did, and this shows a count. This is the accumulation count of the March area. This is a 1 hour chart, but look at this intraday data. Look at
Mm.
where it counts. And this is from a count line area of around 7,500, let's call it. Counts up 15.4 to 16.1. We now have a reaccumulation count, and you just showed some charts of these FANG stocks and how they're coming to life again. And this count now confirms this count, and this count confirms this count, and it counts up to 16.7, 15.8 to 16.7. So just to leave viewers with the notion that there is still potential for more upside ahead, and then
That's pretty
the
good
other,
upside. Yeah.
yeah, good
Well,
upside. And so, and we're still working off that base that was made back in the spring. So we have, if I was to sum it up, I would just say that, so much of the markets is to be able to follow in the footsteps of these large informed interests. This is what Richard D. Wyckoff learned as a young man at the turn of the 20th century, is that he was on Wall Street, and he studied the activities of these large, exceptional market operators. And he attempted to see what they did in the charts, which was hard work because it's not easy to find that information. But he was close friends with Jesse Livermore, and a lot of the technique that he taught is believed to be things that he learned from people like Jesse Livermore and others. And so attempt to follow in the footsteps of these large interests, do what they do, act in concert with them, and avoid, I would say, sort of the noisy news of
the day.
retail, financial news forecasting and so on, and just focus on the charts.
Bruce, I am so glad I reached out to you, and it was just, a shot I took when I saw a tweet you did, and it's one of the best interviews I've done, and I've done 1,000 of them over the years. So, really appreciate you coming here and edifying the F.A.C.E community. And now that you've done this, you're my new trading warrior brother.
Oh,
You
well,
can't get out of it, huh?
I'm all in. This
All
is my favorite thing to do and to talk about.
Yeah.
And I'm so grateful for everyone to have spent time with us today.
And they also want to know, the people that are watching you live and will see the video later, the best way for them to contact you if they're interested in learning more about your teachings.
There is an email address at the Wyckoff Analytics, and just go ahead and send it to me. Say this is for Bruce, and I will get it. And then, and I just want to conclude with this last chart, which is the dollar index. I know this is just the UUP, and you all look at more important indicators, but it was interesting because this decline in the dollar has now in the area of fulfilling its count. It's sort of right at the midpoint here. There is a bigger count for lower prices for the dollar, but I think that's a really good intermediate. And oftentimes when you get into a count zone, you'll consolidate. Maybe we go down to this lower count, maybe we don't, but this is where we would look for either accumulation or redistribution. So anyway, that's just something for the currency traders here. And you can see this has come down into a trend channel.
That's interesting because the dollar index itself, many are showing a breakdown of this long-term trend, and you're showing it just approaching it. So really appreciate the last looks too, Bruce. A great interview, and why don't we get back together in the spring, see what's going on, and I'm glad our paths crossed.
Well, it was a real pleasure, and I look forward to meeting again.
All right, everyone, Bruce Fraser, and you can find him on Twitter at at RD Wyckoff, Wyckoff. He's a
Perfect.
great follow and a great teacher. And I remember just from listening to what you've done right here, I appreciate it. And
Well,
that, that's going to be a
thank you,
wrap.
Dale.
And remember, don't just count your point and figures, your X's and O's, count your blessings. And we'll see you all tomorrow. Good hunting the rest of the day. Thank you, Bruce.